The US housing market is shifting right now, and this is going to affect real estate prices across the country. The Federal Reserve of the United States just recently announced their most aggressive cutback of monetary policy in the history of the country, and this is going to send major waves through the markets. So a ton of people have been wondering what's going to happen with the real estate. When are prices finally going to fall? Are they going to crash? How will they do during a recession? And then also, like, what's going to happen with the economy and how does that affect real estate? And most people have gotten this wrong or don't quite understand what's really happening here. So today I want to go over three things: what has happened with the monetary policy and how this has affected real estate, and then also what's changing right now as we speak, and then what we should do about it. Like, what are the opportunities we can be looking for? Now, if you don't know me, my name is Neel and I talk all things money and marketing. I do my best to put out the most value possible in these videos and share everything as I'm learning with you guys. The only thing I ask from you is if you could hit that thumbs up button and subscribe to the channel. It would really help me because I'm trying to reach more people and grow on YouTube. So just to give you a quick background, what happened with real estate prices had been brewing for a long time and just came to a head in the last 2 years. So prices had been steadily appreciating at a normal pace, I would say, and then COVID happened. So in the early stage of 2020, the markets were in turmoil because we didn't know what was going to happen with COVID and how it was going to affect the market. The stock market tanked. The mortgage market got a little bit crazy because we didn't quite know what was going to happen and people got scared, went straight to the 2008 playbook and started just selling everything. And then real estate was basically on hold because you couldn't really show properties because everything was on lockdown. Honestly, real estate took a little bit of a dip in the spring of 2020, but then something strange happened in May and June of 2020. As things started to open up just a little bit, real estate just started to shoot up, and it was kind of crazy. I think people put an increased significance on their home because they were spending so much time at home. So all of a sudden, everybody wanted to be a homeowner. People who are in a home wanted a bigger home. They wanted a home with a better yard, and there was all this shifting going around. People were moving to different states. They were relocating because now their job was remote and they could live wherever they wanted to. So you saw the great reshuffling happening, and people were just moving around, upgrading, downgrading, buying real estate for the first time. And it was pretty crazy, honestly. So what really spurred all of this activity was the Fed came out and said, hey, we're going to introduce stimulus to the economy. We're going to cut short-term rates, and to reduce long-term rates like mortgages, we're going to start buying mortgage bonds. So they started buying mortgage bonds to secure the housing market. Now, in the beginning, this was actually necessary. They needed to come out to stabilize the market because things got a little crazy in the first part. So they drove rates super low to never before seen levels to make the money almost free. It was so cheap. And commonly I would hear investors saying, look, the money is so cheap, it makes no sense to not take the money. It was just like, we should be borrowing more, we should be buying more with this cheap money. So this super low interest rates fueled a buying frenzy. People were just getting into the market for the first time with the cheapest rates that they've ever seen before. You could really leverage those rates to buy even more real estate. Your purchasing power went up. And then from the investor standpoint, investors were saying, hey, it makes sense to take out low fixed interest rates for the long term and use this as an opportunity to acquire even more real estate. So we saw this frenzy taking place, and as a result, prices really skyrocketed. You saw almost this hockey stick growth with real estate prices in many of the growth markets throughout the country. This continued for the rest of 2020 into 2021. And for the entire 2021, we saw probably the craziest real estate market that the country has ever seen before. Bidding wars on properties in growth markets, people paying $50,000, $100,000 above the asking price. You would see open houses with lines down the street, just people going crazy to get into real estate. And it was pretty crazy to see this happen, but it was also caused by a housing shortage. There's simply not enough homes to meet the home buyer demand, and that was another factor that drove prices up. So you saw demand skyrocket because A, money was so cheap, and then B, buying a home became the coolest thing you could do. And at the same time, you saw supply constrained because not that many people were selling their home, they were holding them. And then also builders hadn't built enough homes to meet the demands of buyers. These two things drove prices up, and we saw record appreciation in the housing market. What's really crazy is I think the Fed made a mistake here because they were saying that inflation is transitory, or this isn't real, don't worry about it, it's going to go away, it's just temporary. They said this for the majority of 2021, and then late 2021 they started to say, okay, inflation's becoming a problem. Meanwhile, regular households knew inflation was becoming a problem because they were paying more than ever for basically everything from food to gas to housing to rents. Everything was just going up at a fast pace, faster than your income was going up. So people were realizing that inflation was a problem, and all the while the Fed is keeping rates super low, and it's making the inflation problem even worse. So when they finally admitted that inflation was a problem, they said, hey, we're going to let the markets know that we're going to be raising interest rates and we're going to be stopping the quantitative easing or buying of mortgage bonds, and we're going to let mortgage rates go up. So they put that news out into the marketplace in the beginning of 2022, and nothing really happened. Interest rates had moved up, but buyer demand was still there because rates just went from ridiculously low to just regular low, and we still had the supply issues, and stocks and everything else was trading at all-time highs. So you didn't really see much of a pullback. But as the months started to go on, you started to see the stock market crack a little bit, and then you started to see a little bit of demand cooling on the buyer side, but nothing much. So then I think what they did was they ramped up their talk even more about, hey, we're going to get really aggressive because inflation keeps posting record highs. So what you found was inflation hit a 40-year high. Their number one goal is now to reduce inflation. So basically they're going to get really aggressive to stop inflation. It's kind of crazy because they went from saying inflation wasn't a problem to now saying inflation is their number one problem. Again, honestly, I think they made a mistake by keeping the rates so low for so long. It wasn't really necessary. They were putting stimulus into the housing market, which is normally reserved for a time when the housing market is struggling. You don't need to stimulate the housing market when the housing market's already going gangbusters. So I'm not sure what the rationale was, but honestly, I think they realize now that they messed up and they're trying to unwind all of this. So in the beginning of May 2022, the Fed announced their first interest rate hike on short-term rates in a really long time. And then also what they announced was that they're going to be shrinking their balance sheet. So they're going to stop buying mortgage bonds, and actually they're going to let them run off, meaning that they're not going to continue investing into this market and keeping rates low. This is causing chaos in the financial markets, and stocks have been trading really poorly. We've seen some stocks really tank, and the overall market is approaching 20% down for the year and could get worse before it gets better. So there is and has been a little bit of bubble in certain sectors of the stock market. That is coming undone right now. You're also seeing this happen in the crypto market, but we're not quite sure how things are going to play out in the crypto market because there is no playbook. Many of these assets never existed until recently, so we'll have to see how things play out there. Now, some people have said that the Fed is not going to be as aggressive as they're saying, but here's what I believe is happening. I believe that the Fed is going to intentionally start a US recession, and a recession doesn't necessarily mean a crash, but here's why they need a recession. That is literally the only way to stop this inflation. This again happened back in 1980, and the only way out of record high inflation was for the Fed to spark a US recession. A recession would cool off demand and cool off these prices, and honestly, that's what many markets need, is a pullback. And normally what they would like would be a healthy, soft pullback, but what happens in real life is assets get sold very quick and very swiftly, and that's what you're seeing in the stock market right now. But real estate's different because real estate people hold typically for the long term. In the last real estate crisis, you saw a lot of people flipping real estate and doing get rich quick, but honestly, in real estate today, it's not the same holder of real estate. These are institutional holders. These are families that are holding property for the long term, and they were well qualified to buy these properties. So for the most part, credit quality is at an all-time high, and the people that own homes are qualified to own them. This is nothing like the market was in 2008, so I don't think the parallels can be drawn between the two markets. But here's what will happen. So the increased cost of money has happened, and rates moved up from 2s into the 3s, then 3s into the 4s, and then now 4s into the 5s. As I'm recording this video, we are somewhere in the mid 5s for the average 30-year fixed rate on a mortgage. Now what happened was, because this went up so quickly, it is causing demand to get jolted a little bit. So you're seeing people who could afford a home and are well qualified, they haven't really changed their plans to buy, but they're just starting to see that, hey, I don't want to be as aggressive because the money isn't as cheap. Now for the people who are marginally qualified, meaning like they were going to buy their first home and they barely qualified for homes at the current price point, for them, the increased interest rates are pushing their purchase price down, and in certain cases, now they can't afford to buy at all. This is actually pushing a few people out of the market, and it's pushing the people who are in the market to be a little bit more cautious. Now, the last thing that's going to affect real estate prices is basically the wealth effect. Now, the wealth effect is how wealthy you're feeling based on your overall investments. So you could easily afford a property, and let's just say the stock market market tanks 20%. Now your investments are primarily in the stock market, and you look at them and you're like, oh, I've lost a lot of money recently, so I'm not feeling as good today. I'm not feeling like I want to be super aggressive on this real estate deal. So even though you could afford to do it, you just don't feel that. And so as a result, you'll see people get a little bit more conservative when they're buying property. This takes months to play out. So we're just seeing the first signs of this right now as I record this video, and we'll have to see how this plays out, and it will depend on how the stock market does over the summer. But make no mistake, the wealth effect is real, and it affects everybody from people who have just a little bit of exposure in an IRA or 401k, all the way up to super wealthy people who have millions of dollars in the stock market. This also affects consumer spending, because when people are having all of their investments at all-time highs, they're spending money everywhere with really no aversion to risk. But when things pull back, now all of a sudden they're second guessing themselves before they spend money on X, Y, or Z. So here's what I believe will happen. I don't believe real estate prices will crash, but I do believe that they're going to flatten and in certain cases pull back. And this is going to depend on the market and the dynamics of your current market. Right now, as I record this video, for the first time in about 2 years, I'm seeing people cut the price of their home. So people are listing a home at record high prices because they wanted to push the envelope and really get the most for their home. Can't blame them for that. And sometimes the agents either aren't aware of these shifts that are happening, or the agent is just kind of like, hey, my seller wants this and I have to try and get it for them. So you're seeing them come out in the marketplace, and when they list it too high, now they're having to go on their heels and cut price. And that shows you that this is going to level off, because the last closed sale is what actually determines the price of real estate. Now the next closed sale would cause the price to go up. If the next closed sale in that community is either at the same level or slightly lower, then that means that you just recently saw an interim peak in housing prices. Now, could they dip a little bit and then eventually go back up and exceed the last peak? Yes, that happens all the time. And honestly, that's probably what will happen in the long run. But for now, you could see the prices pull back just a little bit here. And I'm talking anywhere from 5 to 10% from the most recent high that was recorded in the spring of 2022. So it's important to note that as we head into this recession, I believe we're in a recession right now because this is the second quarter of negative growth. Recession will be confirmed after the numbers come out, so it's backwards looking. But if we're in a recession right now, it's not a terrible recession unless you own a bunch of tech stocks and now you're really feeling the pain. But for the most part, you're going to see the pain is not going to be in the real estate sector. It's going to be in stocks, which we're seeing happen right now, certain sectors of the stock market and certain sectors of the economy. There's going to be more slowdown in certain sectors. Other sectors are going to stay the same or even continue growing. And then the real estate sector will calm down because of this issue. The supply issue or lack of supply issue is probably the main thing that's going to keep prices stable, because there's just simply not enough homes. And then many of the people who bought homes or refinanced their homes at super record low rates are going to be hesitant to give up that type of financing and sell their house, because then they would have to buy a house at a much higher cost of funds. And unless they really want to move or really want to upgrade or really forced to move, they're going to want to stay in the current home. So you're just going to see less people willing to sell. I do think this will change over time, but for now, that is the dynamic. I will continue to watch this super closely and bring you updates along the way. And until then, I will see you guys on the next video.